Good day, friends. Today's lesson is dedicated to an important topic, without which there is no point in building option strategies and trading with them. The topic is call options parity rule and synthetic futures. Unfortunately, I often get questions from clients and subscribers. For example, why is the volatility of put and call options the same? This indicates that people don't understand the basics. They don't understand what the parity rule is, and therefore this is a big gap in knowledge that will hinder the understanding of option strategies. To prevent this from happening, I want to break down in detail in this video how it works, how to create synthetic futures, synthetic call and put options. I'll teach you how to close out your positions if you have a lack of liquidity through different types of options and futures. I will try to remember to make a video on arbitrage using the parity rule and synthetic futures. Okay, if we buy a call at the money options of Bitcoin, I'll zoom in on the chart first. I buy call options at strike 32 and sell put options. See, I get a long futures. It is absolutely identical to the basic futures. It has the same P&L. So, the basic formula follows. A futures equals a call minus a put. That is, to create a bought futures, you have to buy a call and sell a put. Just memorize this formula and now you won't have any more problems, and you will always be able to construct any bought call, sold call, bought put, sold put with this formula. In order to get a sold futures, we have to sell a call and buy a put. And in this way, we will get a sold futures. Now let's make this a little bit more complicated. Let's say we want to create a bought call. How do we do that? We understand from our formula that we need to buy one futures and buy a put. I just moved the formula from the right side to the left side. The call bought equals the futures plus the put bought. We got a synthetic call option from the futures. This is the column where you can see the data. Bought futures 1 unit and bought put 1 unit. We got a bought call option of the same strike as the original option. It is absolutely identical in all characteristics. What do we need to do to create a sold call? We need to sell futures and sell the put option. Now let's try this. Sell the futures, sell the put, get what? A sold call. Good. Now we're going to work with bought put option. We transfer the put option to the left side of our formula, so the put equals the call minus the futures. So we must have a bought call. Let's buy it. And we also have a sold futures. So a bought call minus a sold futures equals a bought synthetic put option. Again, this is the column where you can check all the data. Now, how do we get the sold put option? Buy the futures, sell the call, get the sold put option. Great! We now possess the ability to model synthetic call and put option futures, synthetic call and put options, sold and bought. I think it's very simple. You just need to know the formula and try to do everything yourself at the AE terminal. I advise you to do it after watching this video. Then you will quickly learn how to create synthetic futures, synthetic call and put options. Now I want to give you a practical example. Suppose you bought call options of strike 28 before the Bitcoin price rises. Suppose we bought 1000 call options. The basic asset of Bitcoin has risen significantly in value. Your options went deep into the money. And then there's a liquidity problem, because options deep in the money have a liquidity problem. Market makers don't support options deep in the money. Let's say now the strike is almost 32. Market makers are quoting strikes 31, 30, but they're not quoting 28. There are exchanges such as Bybit, where market makers quote only one strike in the money. So 3 strikes is quite good. If you have liquidity in a put option, you can close it synthetically. Here you have a call option. How do you close that position without being able to sell that option? Easy. You need to sell a synthetic call option of the same strike in the same quantity. Now we take a sold call option at strike 28, which is, it's a sold put option at strike 28 and a sold futures. Now I'm going to the sold strike 28 call option and they just collapse and you take a profit. The bought call option and the sold synthetic call option collapse and you take a profit. You have a profit locked in until expiration. Nothing will affect this. There are no account size limits on the AE exchange, even if you have only $10. When you have a synthetically closed position, the margin requirements will tend to zero. Once again, I recommend you try to make models yourself. Go to the AE terminal and work there. And then you will realize that there's no difference between put and call options in terms of volatility. Let's say the call option is more expensive in volatility and the put option is cheaper in volatility. Wouldn't it be nice to sell the call and make a cheap synthetic call option out of the put option and then buy it? Then we would get arbitrage. But we will talk about that in another lesson. About arbitrage strategies based on synthetic futures and options with parity rule. If you liked it, click on the like button. If you are not subscribed to the channel, subscribe. There's a lot of useful information about option trading here. And I'm waiting for your questions in the comments, and I will make new lessons soon. Have a successful options trading. Goodbye.